almost 20 years ago, in the summer of 1998, I heard about this new state project in the city of Wuxi in China. I was in Shanghai at the time, so I went out to see this new supposed state champion. And what I saw when I got there was very depressing, particularly in comparison to what I'd seen in Taiwan with firms like TSMC and UMC, who were already very quite capable firms. The target of state policy in China, in this case Huawei, had built this fabrication facility, this plant to produce computer chips, but it was empty. They didn't really have any idea what their products would be, how to design these ICs or computer chips. And so it was just sitting there as a form of rapidly depreciating capital. And when I saw that, I said, oh, all right, things are different in China than they are in these other East Asian countries. And probably China's not going very far in the technology industries. But actually, I was wrong. China represents a curious puzzle because when you look at its market institutions, its governance, as many people like to talk about it, they're quite weak, right? Even today, there are a lot of problems with their market institutions, what are typically called market failure or institutional voids. And at the same time, while China has extensive state intervention and state industrial policy, it hasn't worked out very well for the targets of that policy like Huawei. And yet, despite having poor market institutions and not very effective industrial policy, China has experienced a fair amount of technological development in these high technology sectors. So how did they go about doing this? Well, I argue that in China, there's this certain subset of firms called hybrid firms that combine foreign financing with a China-based strategy, a strategy predicated on competing, utilizing intensively resources in China that are really the drivers of China's technological development. Now, the foreign financing is critical because it allows these firms to solve the fundamental issue of financing in China. If you're close to the state, you get financing. And if you're not close to the state, it's much harder to get financing. Well, these firms look abroad for their financing, so they don't have to worry about being close to the state. And then secondly, the people founding these firms are all ethnic Chinese, so they don't have this sort of typical multinational home country bias coming from abroad. They're not your typical foreign firm. They actually want to use China as their home base. Their bias is towards having activities in China despite their foreign financial links. So what am I actually trying to explain here? Well, I'm trying to explain technological upgrading. But these terms, leapfrogging, technological upgrading, innovation, are bandied about in very imprecise ways. So I like to break technological upgrading down into two categories. One is technological learning. Essentially, you're trying to catch up to the international technology frontier. And technological innovation, where you're creating new knowledge at the technological frontier. And I also want to measure upgrading vis-a-vis the international technology frontier. I think a lot of studies of technological development haven't paid sufficient attention to that issue. They've looked at country X, and if it's doing something that it wasn't doing before, that's success. But if the technological frontier is moving further and further away, even if you're improving versus your own path, sometimes you're actually not catching up in any fundamental sense. Secondly, I insisted that technological upgrading had to be for commercial products. And that's because in China, there's been a lot of state intervention in the very way the markets work, in which product markets are determined by competition rather than state procurement. So I wanted to sort of look at competitive marketplaces. And finally, this upgrading had to be somehow captured by the local economy, meaning the Chinese economy, either through the using local personnel or local suppliers. Now, I said there was a subset of firms, these hybrids, that were driving technological development, but there are several other types of firms in China. One are what I called favored domestic firms. So these are domestically registered firms that, due to state favor, have access to state finance and procurement. Typically, they're state-owned firms, but not always. And then there's neglected domestic firms. These are also domestically registered firms, but they have little access to the formal state financial sector or to state procurement. Typically, these are private firms. And then there's the multinationals. These are the firms we all think about when we think of firms that span the globe that aren't from China. So firms like Microsoft or Samsung, all those are multinational firms. Now, these firms had the advantage of foreign finance. They're not involved with the Chinese financial system, but they really have no strong commitment to China. They just make their decisions about investing in China based on their own narrow firm calculus. And finally, they're the hybrid firms that share the foreign financing that the MACs have, but have this China-based operational strategy. They're predicating their ability to compete on utilizing Chinese resources extensively. Now, what explains the differences between these four firms? Well, one is sources of finance. So the three choices basically are little external finance. You have to be self-funding, versus domestic state finance versus foreign private financing. And these differences essentially determine the different upgrading paths between foreign and domestic firms. Why foreign firms in total do worse than, foreign firms do better than domestic firms. But then we also have to explain why MNCs don't promote as much technological development in China as hybrid firms. And here, this China-based operational strategy is what matters. So the ethnic Chinese entrepreneurs that found these hybrid firms have a propensity to adopt a strategy, this operational strategy based in China, the strategy to utilize intensively Chinese resources for both ideational and interest-driven reasons. So in the realm of ideas, when you talk to these entrepreneurs, many of them will cite patriotism, civic-mindedness. They want to help out China. And many of them seem very sincere in this. I don't doubt that. But there's also interest-driven motivations, their own self-interest. And many of these entrepreneurs will also talk about that quite frankly, that they believe they have more knowledge about how to operate in China vis-a-vis their foreign competitors, that the foreign firms look particularly at Chinese human resources and don't really understand how to utilize them effectively. And this is the competitive advantage of these ethnic Chinese entrepreneurs. Whereas if they just stayed in Silicon Valley or elsewhere, they wouldn't have a natural competitive advantage competing against foreign firms. By being based in China, they do. And this difference in operational strategy between the China-based and the foreign-based one embraced by the MNCs dictates the difference between the multinationals' contribution versus the large contribution of these hybrids. Before continuing on with sort of the causal mechanisms, how this plays out, I want to take a brief side tour of what's wrong with state finance in China. And so here we have a table comparing the Chinese financial system versus 44 other countries with their financial systems based on these various models, the French origin, German origin, English origin models. The key things to note here are that the Chinese financial system is very bank-centric. That's neither good or bad. It's just a fact. It's not really as reliant on, let's say, equity finance. What's more disturbing is the overhead costs in the Chinese system are quite high. And even more alarming is the financial efficiency. Here, the higher the number, the better, the more efficient. China is below 0 here, is quite low. Now, those are 2002 figures for China. So one could say, well, the Chinese system surely has improved quite a bit. Well, it seems that it hasn't. The problem with the Chinese financial system is it's very geared, the banking system is very geared to supporting these state-owned firms. And it's trapped in somewhat of a vicious cycle by supporting these firms, by giving them easy access to credit. It actually probably undermines the motivations and capabilities of these firms to compete, meaning they need even more capital thrown at them by the state banking system. And so over time, state banks in China have racked up large amounts of non-performing loans. Now, in an early area, they had this problem, the late 90s into the early 2000s. There were large numbers of non-performing loans in China vis-a-vis GDP. But the state essentially took these loans out of the banking system and into these asset management companies. The reason this actually worked, though, is because China was growing so rapidly. So once those non-performing loans were removed from the banks, even though they weren't officially liquidated or dealt with, they became a smaller and smaller share of the economy as the economy grew so rapidly. But unfortunately, there's been a new round of buildup of these loans in recent years, and estimates vary between 8 and 4% now of loans are non-performing. Now, when you compare to these other countries, advanced countries like the United States and Japan, even during the US financial crisis, they tend to be much lower than the figures for China. But even developing countries such as India and Indonesia have much lower non-performing loan ratios than China does. So this is a recurring problem in China, and arguably today it's a much more significant problem because we're under the new normal, as they call it, right? The growth is slowing down. They won't necessarily be able to grow out of this problem. So, what is the causal flow? Essentially, state-firm relations determine the sources of finance and markets, and those lead to the incentives and capabilities in firms for upgrading. Those interact with this operational strategy to determine the firm-level technology strategy in China and whether they can effectively pursue technology activities in China. And the more pursuit of those activities in China, effective ones at least, the more likely it is that those firms will contribute to China's technological development. Now just to look through the same argument for the different firms. So when you're one of these neglected domestic firms, typically private firms, they're basically self-financing. They have to, any new investment has to come out of their own profits. That actually works okay for some relatively low-tech sectors. But the high-risk, large capital expenditures for technology sectors means it's not a very practical way to fund them. So these firms tend not to have very high level of capability, particularly in tech sectors. They just don't have the financial wherewithal to invest in them. they're domestic firms. So from the literature on the home country bias of multinationals, we can assume that domestic firms really still favor putting activities in their own market. So they're motivated to do things in China, but it's sort of irrelevant because of their low capabilities. They don't pursue technology activities by and large, and so their contribution to upgrading is low. The favored domestic firms have the opposite problem. They have lavish state support. But this lavish support comes with very few strings attached. So they have low incentives. They know they're going to continue to get the state support. They're not going to be shut down. And actually, many would argue that this lavish support, this so-called soft budget constraint, also leads to the atrophy of capabilities. If you're not really concerned about survival, but you know the state's always going to back you up, you don't really do much to hone your capabilities, and so you fall further and further behind. Again, they're domestic firms. They're more likely than not to place their activities in China, but they make few attempts at technological activities, and when they do, their execution, because of local capabilities, tends to be poor, so their contribution is low. The MNCs have a very different financial system that they're dealing with. They have access to finance, but on much stricter terms than the favored domestic firms. This means they have the incentives to compete. If they don't compete, if they don't hone their capabilities, they'll be cut off and probably die as a firm. And these incentives lead to high capabilities. However, when they approach China, they don't really have any strong bias towards China. Oh, we definitely have to put a lot of activities in China. A few multinationals tend to place more activities in China than others. Microsoft would be an example that has a relatively more proactive utilization of Chinese resources. But it's really on a case-by-case basis. So their engagement with China, doing technology activities in China, is variable. And so their overall contribution is relatively moderate. The hybrids have the same advantages of the multinationals in terms of finance capabilities, incentives, but they have much higher motivation to place activities in China. They've sort of embraced this China-based operational strategy. So more often than not, they're pursuing their technology activities in China for the most part, and thus they have relatively high contributions in terms of training new workers, bringing up new suppliers within the Chinese economy. Now, the empirics across the book are as follows. So the first two chapters look at sort of the two main types of classic industrial policy for these sectors globally. On the one hand, you sort of have the bottom-up or cluster approach. And here we look at the industrial zones that China has actively supported over time that sort of try to mimic Taiwan or Singapore, and also venture capital, which is supposed to spur Silicon Valley-style innovation. And then in chapter 3, look more of a top-down, let's build large conglomerates that will be our national champions approach. And I argue in both these chapters, basically, the Chinese state policies have not gone very far, have not really delivered the goods. And then chapters 4, contrast the MNCs and the hybrids approach to technology activities vis-a-vis what we saw in chapter 3 with these state champions, and that they contributed much more. And then in chapters 5 and 6, I look deeply into the integrated circuit industry. I'm not going to talk about that in this talk. It just would take too much time. Many people, before we continue, I want to add, many people ask, well, who these hybrid firms? I mean, what firms are we talking about? Famous ones would be firms like Tencent, Alibaba, Baidu, firms I probably will talk about, SMIC, Inventec. All of these are hybrid firms. Now, in my talk and in the book, I talk much less about the internet space because they're not good. They're not a good basis of comparison. There really aren't many state-favored or even neglected domestic firms in that space. It tends to be dominated by these hybrid firms, so there's no good basis of comparison in that arena. So I tried to look in other areas where there are direct subsector to subsector within the subsector comparison. So bottom-up approaches to fostering technological development and innovation. A number of countries have adopted science parks or development zones to try to engage with multinational firms, learn from them, and create their own local firms, leveraging on the multinationals. Now, China has paid a lot of attention to what has gone on in its immediate neighborhood, what Taiwan did, what Korea did, what Japan did, and a little further afield, what Singapore did. So one of the areas that they latched onto, and policy areas they latched onto, was these development zones. We're going to lure in foreign investment, and then we're going to leverage that to create our own vibrant local firms. However, the problem that they've encountered is the incentives for these zones are not aligned with what the zones really should be doing. So in the early days, when China was desperate for industrial investment, this whole incentive structure of encouraging local cadres to bring in investment, the more investment you brought in, the more likely it was that you would be promoted, was a very useful strategy when China was trying to move from low income to middle income. Today, it's not very useful because it focused on too much of a crude target and never really focused on capabilities that were being brought in. It just focused on raw numbers. And even today, when you go and talk to zone officials, what's going on, how do they look at the investment criteria when they're recruiting investment, it's still basically focused on bringing in the investment rather than worrying about what the investors do when they're there. This contrasts quite sharply with Taiwan and Singapore, where there was a very strong incentive, a very strong focus by the officials on forcing the foreign investors to make sure that they were engaged in upgrading local suppliers. What's also disturbing is a lot of the development zones have become very good vehicles to create valuable property that local governments rely on for local revenue. So they're blindly expanding the amount of industrial land because on the side they develop other complexes that they hope they can sell off and use that as local government revenue. This has led to far too much industrial land development, and basically the investors in these industrial parks have gotten far too good a deal in terms of free land, in terms of not paying taxes and the like. Turning to venture capital, in the early days there were, so China, even as far back as 1984, decided we want to have Silicon Valley style venture capital. Well, for 23 years after that, they did not really have the laws in place to make that possible for the classic general partner, limited partner structure that they use for venture capital in places like the US and the UK. But even in 2000, after 2000, when they did do that, there were still quite a number of problems in the venture capital industry. A lot of the vehicles for venture capital, the local ones, tended to be these state vehicles, and they weren't necessarily interested or given the mission to do classic financing for startups. Many of their financing ended up going into these development zones or other infrastructure projects. In recent years, with this venture guiding fund and then a lot of these mega projects that have popped up for specific industries, there's just been such a large flood of funding that it's sort of skewed the ability to have the right investment price for even for decent, what could possibly be at a lower price, decent investments. What has been the silver lining in all of this has been foreign venture capital firms. Now, these foreign firms have a lot more experience in selecting the firms that are most likely to succeed. Obviously, they don't select the winners all the time, but they have a lot more of experience in this. And in fact, foreign venture capitalists became sort of the major route by which a lot of firms became hybrids, were able to link up with foreign financing. Now, one could argue you don't necessarily need strong venture capital to finance innovation. There are many countries that are very innovative and have not used this. But when we look at those countries, such as Korea and even Japan, they focused on large business groups that were able internally to come up with the financial wherewithal to put in the long-term funding needed for innovative activities. Another example was Taiwan. They didn't really have an effective venture capital industry in the past, but they had these industrial clusters of small and medium-sized enterprises. But China, as we will see, we already discussed the industrial clusters, but the business groups, they don't really have the same sort of Keiretsu or Chaebol-like structures to foster that innovation. Very briefly, I went and interviewed various venture capital firms, both domestic ones, these purely foreign ones, and sort of offshore foreign ones, but run by ethnic Chinese investors, typically in places like Taiwan and Hong Kong, but also firms like Walden based in San Francisco. And what was interesting is they displayed very different patterns in terms of their interest in technology investment. Now, the domestic ones, a lot of them being state vehicles, they were ordered to invest in a lot of different things that had nothing to do with technology industries. So the number of technology intensive investments was quite small. It was highest for these ethnic Chinese foreign VCs, I would argue in part because particularly in the earlier days, let's say the first decade of this century, many of the purely foreign VCs were still worried about things such as the IPR regime, the intellectual property rights regime in China. Oh, if we create technology in China, it will just be stolen. VC investors who were more familiar with developing market contexts said, you know, we saw this before in places like Taiwan. We'll be able to figure out internal mechanisms to protect our intellectual property, so it won't be as big a deal. And then the foreign VCs, they were sort of more moderate between the two categories. Some of the technology investments, but still some of the fear that their technology would be stolen. And also these firms, a lot of them tend to want to focus on more business model innovation rather than science and technology-based innovation. More interested in firms in China like C-Trip than in very technologically intensive firms. Now turning to these national champions the Chinese state tried to foster, one of them is Lenovo. So Lenovo's a very interesting case because while until 2010, a majority of its shares were held by state entities, it wasn't a formal state-owned enterprise like Baosteel or something. Basically, it was a spin-off from the Chinese Academy of Sciences in the early days. The state wasn't very interested in it, didn't think it had much chance of success. But gradually, as it became successful, principally by doing Chinese language software for PCs, the input for Chinese writing, it began to attract more and more attention from the state. So in the early days, it didn't really look like one of these favored firms. But as it attracted more attention from the state, there was a huge internal conflict within the firm. On the one hand, this scientist from the Chinese Academy of Sciences, Ni Guangnan, really wanted to keep investing in technology. We had this great software product. We should keep investing in new technologies, use the money we made to do that, use state funds that are given us to do that. But Liu Chuanzhi, who probably was a more opportunistic business person, said, "What? Are you crazy? The government loves us. We now have access to cheap capital. We have access to state procurement. Why would we want to keep investing in risky technological developments? Let's just be this PC manufacturer heavily supported by the state." And in fact, Ni Guangnan was basically kicked out of the company. What's even more interesting is even though Lenovo is quite large, I'll show some evidence that over time it has lagged more and more its international rivals. So here is sort of the mid-90s was the turning point. So they had the big fight in 1994. Here, its state procurement was 13%, and then it went up into the 20% for the rest through 2003. More interesting is, so in late 2004, with state support, Lenovo bought IBM's ThinkPad division. Before that, Lenovo was not that large of a player, definitely did not have a large international presence, and the price points for its products were quite low. But just buying IBM, which was sort of the premium notebook manufacturer among the non-Apple, the PC notebook manufacturers, it became the manufacturer that had the highest prices of all the major manufacturers, with the possible exception of Dell. We don't really have data. I don't have data on Dell for those early years. But as you see over time, the trend line has not been good for them. They were given this advantage, but they haven't been able to maintain it. Even lowly firms like ASUS from Taiwan, which wasn't even manufacturing computers back when Lenovo took over IBM, have sort of caught up with it. And I would argue one of the reasons for that is because Lenovo can still just continue to rely on lots of state support. So from the time of the immediate merger, when it had a very large international presence, in many ways, the weight of the international sales in overall sales has shrunk. It's sort of retreated back to China. And it's been continually relying on things like the Appliances to the Countryside project, where they got almost half of the rural subsidies, just Lenovo themselves. There were two non-mainland Chinese firms that also received it. So HP got less than 1%, and Acer from Taiwan got less than 0.2%. But the bulk of these went to Lenovo itself. And what you'd really like to see from a national champion is once they get this support, they should be investing in new things, right, and trying to create new technologies to help drive the economy forward. But Lenovo hasn't really done that. When you look at its international rivals, they're diversifying away from PCs because it's a relatively low margin, stagnating business. Lenovo isn't doing that, or at least not very effectively. And surprisingly, Lenovo hasn't really created many patents using China lead inventors. It has far fewer than Invitech, this interesting half Chinese, half Taiwanese firm that's only 40% of the size of Lenovo, but has almost triple the patents. Lenovo's kept trying to get in new businesses, often just by purchasing other units, just like they did with IBM ThinkPad division. So they bought the Motorola handset division from Google. That has not worked out well for them. They're now, trying another route to state procurement by buying IBM's low-end server division, with the main target for those products being China's own state banking system, in which there's been this gradual push to basically get rid of reliance on foreign products. Now, the one firm heavily favored by the state that actually has been a major contributor to technological development is Huawei. So if you look at the domestic firms from 2003 to 2011, Huawei accounts for about 57% of their lead inventor patents from China, more than half. But Huawei is strange because it did not really respond to these incentives, state procurement, easy access to state capital, by sitting on its laurels and just collecting these economic rents that the state gave it. To his credit, Ren Zhongfei actually sought out competition, sought out the much harder path. So when its crosstown rival, ZTE, also based in Shenzhen, was happy sitting at home, just selling into the domestic telecom market, in 2004, Huawei had already sold 40% of its sales overseas, and a majority of those by 2005. And they weren't just anywhere overseas. They actively wanted to sell in advanced markets because they knew that's where the customers were most demanding. In contrast, even later on when ZTE did sell more overseas, it tended to do so in developing countries where it got very generous loans from the China Development Bank, and there was less competition from the big multinational players, and the local buyers were much less demanding. Huawei also did some very high-risk things based on really wanting to hone its technological capabilities. So they knew they wanted to go abroad, they wanted to learn through foreign competition, and they knew that actually, unlike China, there were a lot of vendors abroad using CDMA technology, not the GSM technology that was used in the Chinese telecom market. So they spent a large amount of money researching CDMA in 2002. Despite all signals from the Chinese state, we're not interested, we're not going to give you any money to do research on CDMA because we've decided we don't like CDMA. In fact, this almost bankrupted Huawei, but luckily they found a Spanish buyer for some of their CDMA-based equipment that rescued them at that time. And if you look further on, so for Generation 3 technology, the Chinese government came up with their TDS CDMA standard, and certain firms like Datang and ZTE became major standard bearers for the standard. They received a lot of research funding for it, but Huawei, they weren't interested. They knew that this was never going to be a standard that would have significance abroad, so they never decided to get close to the state to use that. They're still state favored in many ways, but they sort of eschewed over-reliance on the state. Now, many people like to talk about the globalization of R&D, that multinationals are putting R&D facilities all over the world now, the war for talent, searching the globe for talent. So one would think that multinationals would be putting a lot of research and design activities into China. China has a very large population of scientists and engineers. It makes sense that they would move there. And to some extent they have, But there's been real tensions for the MNCs in utilizing China. So they've always been very concerned about IP theft. Now, in the past, I think that a lot of those concerns were highly warranted. Even today, it's not probably the protection is not as good as it is in a lot of the home countries of these multinationals. But their solutions for IP theft have worked against them. So one thing they did is they tried to segment the R&D up into many steps and just put one or two of these segments in China. So if you were a Chinese technologist working for one of these multinationals, you would never get to see the whole architecture, the whole picture of a given product. You would just be working on this one segment. So even if you stole that, you wouldn't really be stealing the valuable IP. Another thing they did is that in products where there was an actual sort of overall architecture phase, they very rarely put that work in China. But this has become a real problem for China. So Frank Gredenhaus, the former head of Philips R&D in China, who's now my colleague at Zhejiang University, he admits that for Philips, they have this real problem. They don't offer interesting work because of these strategies. So it's becoming harder and harder for them to recruit top talent, right? The scientists and engineers in China, it's not just pay. They want to be able to improve their own skill set. How do you do that? By seeking out more and more challenging work, which a lot of the multinationals aren't offering. Well, which firms are offering this work? Well, the hybrids are the ones that are doing so. So they always knew that they were basically going to be China-based firms. That was their strategy from when they set up these firms. So they figured, okay, we're going to have to use other means for dealing with these IP issues. We're not going to segment it and put a lot of the valuable R&D outside of China. It doesn't make sense for our own strategy. They did things like having protocols where people would be working on workstations, doing design on workstations that had no external ports, so you basically couldn't download anything. With a lot of these electronic design automation tools today, the files are so big, you couldn't just memorize the whole product. You would really have to download it to steal it. Well, it's very hard to do so with the protocols they put in place. And they, in contrast to the vicious cycle of the multinationals offering uninteresting work so they can't recruit good people, they have a much more virtuous cycle. So they're offering interesting work. So this is good training opportunity. These are good training opportunities for technologists, and they're able to thus retain their local staff and build their own capabilities. Now, there's also a few, the few capable local firms like Huawei also experience the same sort of virtuous cycle, but there's just a handful of those firms. So when we look at US utility patents where the lead inventor is based in China, what we find is by far the largest number are coming from these hybrid firms. The multinationals are second, and the domestic firms really lag. And this is quite surprising. As we'll see in a second, the hybrid firms are by far the smallest category of these firms. Now, when we look just at IT and biopharma, thinking these are sort of classic high technology sectors, you see the same pattern, but it's even slightly more pronounced in favor of the hybrids. The hybrids typically are focused in these sectors in any case. To get a sense of the scale we're talking about, so the domestic firms are the large bulk of firms here in China. If we're looking at fixed asset investment or R&D investment, it's over 90% for fixed assets and 70% for R&D. The hybrids, by contrast, they're less than 10% of an R&D investment, but they get the highest returns, and the multinationals are in between the two. Now, it's interesting to note that actually the gap between the hybrids and the domestic firms is much, much larger in these high-tech sectors than in mature sectors. In fact, in mature sectors, the domestic firms have more patents than the MNCs and hybrids. But remember, they still underperform if you look in terms of the inputs. But this is sort of in line with the very interesting work by Lauren Brandt and Eric Toon from 2010, 2016, where they argue the sectors where purely domestic firms have been successful really are in these mature technology sectors. What's also interesting is in recent years, starting in about 2005 or so, there's been a massive subsidization of patents, particularly including foreign patents, applying for patents to the USPTO. The vast majority of those subsidies have gone to domestic firms. So it's basically essentially much cheaper for them to patent, and yet they still underperform. So what's the big picture beyond China's own tech sector? Well, I'd argue that there are lessons for other developing countries, that these other countries should look at foreign investment not just simply as additional financial capital, but also as a mechanism, perhaps, to input these foreign institutions. By linking up with these foreign venture capital firms, these hybrid firms weren't just getting money. They're also getting the advice, the legal structures in place that really help these firms compete, particularly in foreign markets. What's also good news from this sort of hybrid experience is that high state capacity may not be required. Now, many people have argued that Taiwan, Korea, Japan, Singapore were successful because of high levels of state capacity and effective industrial policy. And I think that by and large is true. But the problem is, when you look at the wider development world, it doesn't seem widely applicable. A lot of other countries have done industrial policy and not done as well as Taiwan and Korea in particular, as the only two countries to go from low income to high income in the post-World War II period. So it's encouraging here that there's this other route where you don't have to rely on high state capacity. Another issue is foreign firms can be drivers of development. Many people in the past said, well, foreign firms are not really interested in local development, so they won't be the vehicles for it. The only exception, perhaps, would be Singapore, where the state was very effective at luring them in, but then forcing them to upgrade their facilities in the city-state. But here we have another mechanism. It's not effective state officials. It's this motivational mechanism by shared ethnicity, right? That these ethnic Chinese entrepreneurs, either for ideational reasons, patriotism, or interest-driven reasons, they think they have a natural advantage through setting up shop in China, will pursue local activities. Other developing nations could potentially pursue a similar mechanism via co-ethnic transnational technology networks, the type of networks that Annalise Saxenian and others have talked about. I have to emphasize there are sectoral constraints, though. This is clearly only applicable to these high clock speed, fast-moving, technology-intensive sectors that are also disaggregated, that you can be a firm that's very successful by focusing on one small block in this industrial value chain. Other sectors that don't have these characteristics, you probably aren't going to be successful using this model. And we can think of reasons why, right? If you look at the auto sector, sort of medium tech, medium clock speed, but very much these tightly knit relational networks, you need a lot of co-investments by different firms together to create an auto industry. It's not really going to be fostered by foreign venture capitalists giving you money. Similarly, jet aircraft, right? Very long time horizons. technology intensive high, low clock speed, very integrated. When it's not integrated like Boeing, there were disasters. You probably need the state directly or indirectly behind that kind of very long-term, high levels of investment. This model won't be work for that. And just quickly, so you have this hybrid model, but how does it compare to these others? So there was the old Washington consensus model of we should be wary of industrial policy. We have to focus on free markets, or in its revised version, good governments, market building, and that leads to development. They would regard globalization as it currently stands as basically a boon. The problem, of course, is most countries haven't really been able to take full advantage of that, and they can't really explain why that is the case, other than the saying they haven't done market building well, but that begs the question of why that is so difficult. Then there's the state revisionist view that you need state or state societal alliances to correct for market failure, and that globalization, to the extent it constrains states from doing this, will lead to few opportunities. Again, some states were able to do this quite effectively, but I think they're too pessimistic overall about the current opportunities available out there in the world. And then there's these newer transnational models, whether they're talking about transnational technology networks of individual technologists who maybe lived in Silicon Valley for a long time and then returned to their home country and created these links between the two places to foster development, or others focus more at the firm level, these global production networks, and how developing countries, basically to develop, need to link into these networks, engage intensively with these leading multinationals that will upgrade their suppliers. Here, they have a positive view of globalization, but they don't really explain or sort of underestimate how difficult it is for these various places to really engage with these networks on the global production network side. And for the transnational technology networks, they don't really take into account the local institutions and whether or not they're a good fit. They just sort of assume people move to advanced countries, learn things, and then can engage with their home countries as long as the home country is amenable to learning them back. And I would argue it's a bit more complicated than that. So this hybrid model sort of addresses both government failure that the Washington consensus worry about, and the various types of market failure that the statists and the transnational networks theorists worry about. So foreign finance solves static market failure. You basically are able to get access to finance to do new things. And firms will be willing to invest more towards new activities that in the short term may not have a return via this commitment to the local market through this China-based operational strategy. But here again, as I said before, you really need to be aware that it only works in these certain limited sectors that are disaggregated, fast-moving, and technology intensive. So what will the future be like for the hybrids? I mean, will they be able to continue to contribute to China's development? Well, in 2013, there was the third plenum in November of that year. At that time, many people were very optimistic that China was going to radically change its financial system. There was going to be a lot less discrimination against private firms, a lot less support for state-owned firms. If that had actually, those reforms had succeeded, you wouldn't need hybrids anymore, right? You could just be a local private firm and have access to finance without looking abroad for it. However, it's less and less likely that these third plenum reforms are going to succeed. In the almost 4 years since then, the advances have been pretty minimal. So it's much more likely we're going to get some sort of muddling through scenario where there's not much change to the system. And in that case, these hybrids still have a positive role to play. Promising private firms can't get funding from the state system. These hybrids can from abroad, and so they will still do so. Now, there's a third possibility that lack of reform could lead to a sudden stop, as Michael Pettis would put it, that leads to severe economic distress. As social scientists, we have to be modest and realize we're terrible at predicting systemic change. So how likely or unlikely this is a big question. And more to the point, what will this crisis lead to? Will the system survive, or will we see something new? If the system collapses and you have a new system that doesn't have this state bias towards certain firms, then again, the hybrids would not be needed. And more in the shorter term time frame, the Chinese government in a lot of areas have been very active in recent years in industrial policy, a lot of these various mega projects for particular industries. If there were to be successful reform, that would mean that these industrial policies would be engaging a wider number of actors, not just the same old state-owned firms and a couple other favored firms. And as Nick Lardy would also argue, that would probably mean that the industrial policy making would become more effective in China, right? One of the reasons it hasn't been that effective is they keep turning to the same problematic state-owned firms. Unfortunately, it looks more like in the short term, they're continuing to use the same old firms. So the industrial policies that have been announced in recent years, such as the new one in 2014 for the semiconductor industry, will not be that effective just because they're not incorporating the most effective, capable firms within the Chinese economy. Thank you.